To recapitulate the concepts that have been covered in Module 2, I think it's fitting to lay out what makes a good LBO. And while I realize this is covered in more detail in the Wall Street Oasis PE interview course, I think it's still worth rehashing here to bring everything we've learned together. So, what does make a good LBO candidate? First, as we saw in Module 2.6, one of the best predictors of returns is buying in at an attractive value. To add to this, though, while you may be able to spot a bargain at first sight, in competitive auctions, PE investors will more often look for an angle or favorable deal dynamics that allow them to win on softer factors while bidding a lower price than competitors. For example, there are sellers that may not just be looking for top dollar and care about other considerations like cultural fit or alignment of vision. Additionally, since LBOs must sustain a large debt load, another key aspect we search for are companies with steady, predictable cash flows to service this debt, generally high free cash flow, and some sort of moat that helps to prevent margin erosion from competitors. A few ways investors often tease this out is by targeting recurring revenue businesses, say software or anything that sells on a subscription basis, looking for companies in stable industries that are not likely to be disrupted by some new technology. And they also like competitive advantages that may allow the business to command a premium to competitors. To add to these, opportunities for cost savings are viewed as a major plus, which can heighten cash flow. And generally, PE investors like businesses whose cash flows are unburdened by high capital expenditures. Though I will say the catch-22 here is that companies with a large capital base can often get better debt financing terms since there are more tangible assets to be collateralized. The third core factor investors seek is a strong management team. Since the PE firm is not actively managing the day-to-day of the business, they want a strong, competent management team that can handle the vicissitudes that come with running a business. Another item that is worth mentioning is discernible exit opportunities. It's all fine and dandy to buy a business at an attractive value, but if it grows so large that no one else out there can buy it from you, then how are you going to monetize your investment? You're then going to be limited to IPOing, but this reduces the range of possibilities, such as sale to a strategic that could fetch a higher valuation, and it also makes you more susceptible to the whims of capital markets. So before you enter an investment, you have to give some consideration around the feasibility of an exit. Lastly, a factor PE firms often like is targeting a big fish in a fragmented space. Put another way, being the 500-pound gorilla in the room can afford a significant advantage over smaller competitors in order to preserve margins. Moreover, a strategy that has become popular, especially with PE-backed companies, is the technique of a roll-up strategy. This is where you buy a platform investment, but then use company-generated cash flows to acquire smaller competitors that tend to trade at cheaper valuations. Not only can this strategy get you more scale, it can also help you buy down your multiple. In this example to the right, if we acquire a business at 10 times, but then through add-on acquisitions acquired 50% more EBITDA at a much cheaper 5 times, we can see that on a pro forma basis, our net buy-in multiple was really more like 8 times. So this can be a clever backdoor strategy to effectively buy your investment at a cheaper value, which, as we know, is ultimately the best predictor of returns.